Sell-off is over, right? We're working on potentially day 9 in a row, one of the best rallies that we've seen in 20 years in this market. And it's coming at a time when we're seeing a relaxation of concerns around a potential U.S. recession. In terms of what happened 2 weeks ago, we had this really bad ISM manufacturing report, a non-farm payrolls report that was a little bit weaker than expected, and then the Japanese reaction, of course, on Sunday evening going into Monday. But at that time, we saw that Fed rate cut odds really kicked higher. In fact, that Monday, August 5th, there was a 73% chance that the Fed would cut rates at least once within a week and 6 cuts total by the end of the year. Obviously, that was overcooked, but as those rate cut odds have come back in to now where the market's pricing 3 and potentially 4, which still seems high, we've seen equity markets bounce back. And it goes to show that as the recession fears have come back in, stocks have enjoyed this. Why does that matter? Because it means we're in a good news is good news world, a bad news is bad news type of world. Which brings me to the Jackson Hole Economic Policy Symposium this weekend in Wyoming. Fed Chair Powell, among many other Fed officials, central bankers from around the world will gather out in Wyoming to discuss the latest fads and trends in monetary policy. But Fed Chair Powell's speech isn't being watched for a big shift in policy like it was in, say, 2021 when they moved to average inflation targeting. This time, they're looking for clues about the actuality, the likelihood that we'll see a rate cut or more in September. I would caution people that the market is probably still overbaked because there are odds of a 50 basis point cut still on the table, and the Federal Reserve, outside of emergency conditions, has never started a normal rate cut cycle with the 50 basis point cut. So Powell this week, when he comes out to speak, he's probably going to have a tone that sounds a little bit more hawkish on the margin, promising fewer cuts than what the market wants. But that's not a problem here. This is a good news is good news market. A Federal Reserve chair that's telling us the world isn't ending, recession isn't nigh, and we can take our time making sure the data is right before we embark on this cutting cycle, ultimately is the sentiment that carried us higher from the end of last year through the early part of this year. And so right now, if we can find ourselves with an optimistic and perhaps not so dovish Fed this week, any weakness we see in equities, to me, is weakness that we should fade, which I know seems ridiculous because we're working on day 9 in a row here, and how often does that happen? And statistically, we should be looking for reversion. But if there is reversion going into Friday, let's examine the stats on the table right now. 1 week moving average above its 1 month in the S&P and the NASDAQ. The VIX is below 15. When those conditions have been in place for the better part of the last year, the best thing that you can do is simply look long at the money call spreads and then go to sleep. So if the market's returning to a state where we're comfortable with Fed policy, not really worried about recession, and we get that this Friday, next week's a smooth week sailing into Labor Day.
Sosnoff?
Thank you for listening, Tom.
What he's saying is you should be covering your futures now, if not sooner.
It's funny because I listen, but none of it really registers with me, if that's fair.
Hey, I'm Charlie Brown's teacher.
You know, my brain works just in a different way. Like I have trouble processing. I have a lot of trouble processing the whole story because I feel like it's the same story that everybody's been talking about for so long that I'm not sure why it matters at all. I don't think it's any different. I don't think anything's changed. I think.
Well, then can you expand on what do you read then that is coming out of the bond market? What's the story that bonds are telling us with ZB at 124 and this rate cut cycle?
I think 124 is no man's land in the bonds. Mm-hmm. I think 125 is a very attractive level to potentially get short bonds, or 125, 126. When they fell from 126 last time. But 125, 126 area is a very interesting area to get short. I think, between 120 and 122 is an interesting area to get long. And everything else to me it's just no man's land right now. So it's not that interesting. I think what's more interesting is the stock market, because the stock market, like you said 8 straight up days. I thought it was actually, 8 straight up days. And
looking at SPY and QQQ, those were up 8 days in a row. The futures or the indexes, you may get a slightly different reading.
No, the S&P futures are up 8 days in a row too.
Oh, good. Well, that's great.
Yeah. So no, you've got this. So that's way more interesting to me because as a trader, you start to think about what are the chances of 9 straight days, 10 straight days, 11 straight days, that kind of stuff. And then you start to think of things in other terms, potentially risk reward wise. Like I'm starting to get short here because risk reward wise, I've talked about this many times. I love the risk reward at these levels. But, statistically, can you have a 9 straight up days? Of course, but you're down into like less than 25 basis points. How about 10 straight up days? You're down to, 11 or 12 straight basis points bet. I mean, it's kind of crazy when you get those odds. Like I wouldn't ever want to bet on that. It does happen, but I wouldn't want to bet on it. So I think that's the more interesting story. Like trying to, as a trader, I don't really care what the Fed does on Friday. It's Tuesday. That's all. Like, so they're going to say whatever they say on Friday, the market will react accordingly. Between now and Friday, why does that matter? That's just how I think. Trade what's in front of me today. Weird market.
I think actually you raised a point about bonds, right? What's in front of you right now is not actually that attractive. I know Dylan's been evangelizing the long TLT position, but the reality is, if you think about when ZB was trading at 126, you're looking at a world where there are 6 cuts priced in. And so if we still have some of this excess in the table and the Fed's probably going to give us a more hawkish lean this week, if you see any rallies in bonds the next few days, it may be worth fading. And likewise, if we get that weakness into 121, 122, having the levels in mind, dips into there probably can be faded, right? If there's a spike and fall, we can sell some put spreads. If you're more bullish like I am, you could look at some out of the money call spreads even to have some upside convexity. But I think that's the important point where we kind of are in the dead zone in the bond market right now. We obviously aren't so overcooked like we were 2 weeks ago, but the Fed only told us they were going to cut once this year when they gave us their new Summer of Economic Projections in June. For them to make the leap to 4 in the final 3 meetings of the year, again, that's a 50 basis point cut in one of those meetings.
It doesn't matter. The Fed doesn't matter, though. It only matters where the bonds are trading. And
they're not trading at a place that's good value. Either end is the point.
That's right. Not for short premium, not for anything else. So
right.
I have to think that the trade right now, looking forward for the rest of the week and everything else, to me, it seems the trade is in the equities because the equities have had the biggest move. The equities, you could argue the equities have been the most violent, both downside and upside. You can argue that, this is the place where you have the most risk and the most opportunity. That's what I'm watching. That's all I'm looking at.
You mentioned this rally here for 8 days in a row. This is a really unique occurrence, right? Like this doesn't happen that often in history.
It's happened. We've had 6, 7, and 8 day rallies a couple times this year. So it's not like this crazy rare thing, but I think we've had it a couple times this year.
Well, we've only had like 6 occasions since 2003 is the point I'm getting at, right? But these aren't things that happen. 8 day rallies aren't things that happen at the end of bull markets. In 2021, when we had an 8 day rally that year, the market returned 26.9%. 2019, it returned 28.9%. 2017, 19.4%. 2013, 29.6%. I leave out the stuff in the pre-QE era because it's a totally different economic and financial regime. But this year, going into yesterday, we were only up 16.4% year to date. So yes, the market may be overcooked in the short term, but this type of violent upside behavior is something that typically occurs in the midst of a very strong bull market, which, by the way, we're back above the uptrend from the October and April lows, that big technical breakdown that all the people like myself are screaming about. The world is ending. The uptrend's over. We're back in it now. And now we have this stat about this 8 day return in our pocket. It feels like any dip should be bought and any spike in vol this week, we need to look to fade. Statistically, it's unlikely that this streak continues, of course, even if it has before. But this is a strong technical setup once again, guys, going into the final 4 months of the year.
Chris, I'm not going to let facts get in the way of a good story here with Tom Sadnoff. If they've had 8 or 9 up days in a row this year, a few times, we had it.
We have. It's a good year. Still a bull market.
There you go.
We've had long streaks, not 8 or 9, but we've had long streaks. We've had 6 or 7.
This is the longest streak since November 2020.
I agree. But originally I was thinking 6 or 7. We've had a couple of those.
Yeah.
But it doesn't matter. It's like, again, that's not the interesting thing. The interesting thing here is that we've gotten to a point we're a little extended. So it's kind of, I think it's an interesting spot. If you were picking a spot to jump in, it's an interesting spot. That's all.
Yeah, Tom's talking more like the here and now. And Chris, you're talking a little bit of a longer projection. And by longer projection, I just mean like month 2 or 3. For Sosnoff, he's looking at the minutia of the move right now and just thinking, yeah, you know what? Maybe even you yourself, Chris, if you were looking at this in a short-term view and you said, well, this is the first time this has happened in almost 20 years, well, maybe it's not going to continue for tomorrow.
Of course. Yeah, right. And that is the market, right? It's people with different time frames arguing about their opinions, right? So totally longer term, right? If I'm thinking about if I wanted to get long in this market right now after 8 days and thinking that the returns are still positive, I need time on my side because short term, this thing is probably cooked. It probably needs to take a breather. So if I'm thinking what happens this week, probably leaning short. If I'm thinking what happens over the next 3 months, forget the election, just leaning long. Elections like Democrats and Republicans being elected because they both spend far too much money. Right, it's a question of the time frame functioning here. Otherwise, I'm with you completely, Tom.
I think the market likes what's happening politically because it looks more and more like like it's going to be gridlock, and I think that's what the market likes the best. I don't think the market really cares what the Fed does because that's already priced into the bonds. I think the market cares what's happening a little bit more in Washington, and I think gridlock is the best possible outcome for stocks. You don't want anybody that having too much control, and you don't want too much of a change in policy. So we'll see. I mean,
Well, let's actually talk about that.
Sure.
Because there has been some changes here. There were some economic plans. I don't know if we could say that they were announced last week by the Harris campaign because there certainly have been scant on details, but this price gouging proposal raised everyone's eyebrows. I want to make a point here. People can look this up themselves. Don't trust me. Go to your Google or Ask Jeeves machine and look up how many times administrations historically have put forth mandates about price gouging, and then look to see where they've actually gone. And the answer is it's happened about a dozen times before. And where have these mandates gone? Absolutely nowhere. It's populist messaging. But when we look at what happens in gold and silver, even if we are in a gridlock world, what does that actually mean for fiscal policy? It means that we're only going to get continuing resolutions and debt limit extensions moving forward, which means that the fiscal policy passed under the previous Democratic trifecta with Pelosi, with Schumer, with Joe Biden, that is by and large the framework that the budget is based around. So you get continuation of that. That means deficits continue to grow, debts continue to grow. And while we have these deficits and debts growing with policy proposals to stop price gouging, which could cause inflation and other supply chain issues down the line if the federal government really got involved, we would very well be looking at a situation where that's occurring against the backdrop of lower rates. And gold and silver like lower rates. In particular, they like lower real interest rates. And gold's breaking out to new all-time highs here after a 4-month consolidation. I see a range in the GCV Z4. Can't believe we're in December expiry already. That contract, 2350 up to 2725. It's a 175-point range. 25, excuse me. It's a 175-point range that gives us a measured move of $2,700 an ounce. Silver has just broken its downtrend from the July and August swing highs. The dollar is falling apart. This is kind of the perfect storm for precious metals right now. So as I like to say, if I want to short gold here and fade this, I'm not going to do it through options because gold and volatility tend to have a positive relationship, at least when gold's rallying. I'd rather do it through something like GC or MGC, depending upon people's account preferences, or even GLD. But this is a bullish breakout that I'm not fading. As for me, I like the metals, and I think we should examine them, what's happening in context of the political situation here. Gridlock's coming, and it means that nothing's going to change, more debts and higher deficit spending.
Well, I'm getting shorter right here. Just getting filled right now, partially.
That sounds very logical, is what he said, but he's getting shorter right now.
I mean,
it's not going to $2,700 today. This has been a 4-month consolidation. We have, it's going to take some time, but gold and silver both look very, very constructive. They look very constructive technically.
I need people like you around because I need people to build the bull case. It's good for business. It's good for the way everybody thinks.
Let me give you one more bullish tidbit before we go out the door here. I brought this up on last call yesterday. So much of the past 2 months has been about this consternation over whether or not AI is going to deliver any results. In fact, in a Let Me Explain episode that we had in July, we reviewed some of the talking points from a Goldman Sachs report about whether or not AI would ultimately deliver the results, or we'd stay in this picks and shovels phase where it's just companies selling hardware to one another. And sure enough, the Walmart CEO was out in the earnings call where he said last week that it's given them basically 100 times productivity boost for cataloging over 150 million different items. It's saving countless people hour over time, and that means these people can be redeployed into different areas to do different tasks. So if a company like Walmart, which near $600 billion market cap, is saying that they have actual use cases for AI, this is going to start to trickle downstream. Some of these smaller and medium-sized enterprises that may have not wanted to make the upfront capital investment because it's an unknown, they don't have the budget to spare to make these kind of mistakes, they're now starting to see that the bigger companies are getting results out of them. And so I think the runway here is being extended Semiconductors are behaving way more aggressively right now, and they too have started to jump back into their uptrend from the October and April swing lows here. So if the generals in the market are regaining their posture, if the Mag 7 have regained their posture, I know we're going to have all the arguments about concentration risk moving forward, but the leaders are becoming leaders again, and the AI narrative may very well get some new life breathed into it, which I would point out, stocks really haven't done anything in 2 months. We've been trading sideways, so maybe it's time for the next leg higher.
The only thing I want to say about that is that it sounds good, but NVIDIA's already up 30% off its lows. The SMH already up, AMD already, I mean, these stocks have already exploded. The NASDAQ has rallied, 2,000 points.
Why not more?
It's not like we're discovering, you're not early. Like if you had said this.
No, of course not.
2 weeks ago, it would have been interesting. Like we can't be masters of the obvious because that's what everybody does. And it doesn't, I kind of don't think that
Sure.
works. So like.
Sure. But again, my overview is macro and technical, and being a momentum guy, momentum is like a ship with macro turning in the night. So missing the tops and bottoms, right?
That's so hard. That's so hard for traders because you have to guess that, like you have to pick your spots and guess. You can't kind of wait because you can't count on 8 or 9 straight up days. And, it's not you, but it's everybody starting to talk all of a sudden really bullish about all these crazy, AI stocks again. I mean, they've already had a ridiculous move. Again, the NASDAQ's up 2,000 points. Now everybody wants to buy them. I don't know. I don't like it.
Well, Tom, just as a point to put a cherry on top of this, I think of people like Anton's dad, for example, who purchased NVIDIA on the literal high of all time, the day that it hit the all-time high. And so someone like him, he's still underwater in his position. So
there are
depending upon where you got in this market, you are looking flat. Again, the market hasn't done anything in 2 months if we think about where the prices were back in June. So for a lot of people, they've just been grinding sideways right now.
Okay, that's fair.